Hi, Daniel here. In today's video, I want to talk about the potential volatility, drawdowns and losses that you may experience when investing in the emerging and developing markets. Now this video will be split into three parts. The first part looks at the reason as to why the volatility and price swings are more extreme in the emerging and developing market space as compared to the developed market space. The second part looks at the lessons that we can learn from historical performances and behavior of investing in emerging markets. The last part looks at what you can and should do when investing in emerging market investments, especially during times of high volatility, drawdown and losses. Without further ado, let's get started. Part 1. Why are things more extreme in the emerging markets? Now there are three reasons as to why things are more extreme in emerging and developing markets like Asia as compared to developed markets like the United States. The first is that generally, emerging and developing markets tend to experience a higher level of social, political, and economic instability, which contribute to higher levels of uncertainty. As such, price swings tend to be more extreme as the fear and the greed of the investors are amplified by the higher levels of uncertainty when investing in the emerging markets as compared to the developed markets. Now the second reason is that most emerging markets are susceptible to the developments in the developed countries. Now there's this saying that goes like this: when a developed market sneezes, the emerging market catches a cold, right? This is because most emerging markets are heavily dependent on the developed countries for things like financing and demand for exports. As a result, emerging markets are affected by more factors as compared to the developed markets, thereby making them more sensitive to global developments. The third reason is the perception that investors have towards emerging markets and developed markets. Generally, most investors would treat the developed markets as a form of safe haven, and they would perceive emerging market space to be a riskier form of investment exposure, and as a result, when uncertainty increases, most investors will sell off their emerging market investments and buy developed market investments in an attempt of a flight to safety, right? The difference in the perception in the safety of the investment causes huge levels of disparity in the short-term demand and supply of the emerging and developed market investments. All in all, the combination of all three factors creates a more extreme behavior when it comes to things like price volatility, drawdowns and losses for the emerging market space as compared to the developed markets, especially in times of rising uncertainty. Part 2. Should you be afraid? Now, should you be afraid of the more extreme price behavior when investing in the emerging markets? If you are currently sitting on unrealized losses in your emerging market investments, is there a cause for concern? Should you sell off your investments in an attempt to cut your losses? My short answer to your question is no.
No, God! No, God, please, no! 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 No!
If you have a long-term investment horizon, there is really nothing for you to be worried about. And here's why. If you were to look at the historical price behavior of the emerging market index, what you realize is that while the potential volatility and drawdown losses are high in the short run, there is no cause for concern in the long run as the emerging market had always recovered after every major drawdown and losses. In fact, since 1988, inception of the MSCI Emerging Market Index, there have been 8 major drawdowns in the emerging market space where the market suffered more than 25% in losses. And in each instances, 8 out of 8 times, the major drawdown was followed by a significant rally and the prices eventually recovered. If you were to blindly sell off your investments in panic, you would have materialized and locked in your investment losses instead of sitting through the recovery and profiting from the eventual economic growth and development of the emerging market space. What about the Asian markets, which I have constantly preached about when it comes to long-term investing? How did they fare in times of uncertainty? Now, if you were to look at the historical price behavior of the Asian ex-Japan Equity Index, The same story can be said for the Asian markets as what we had previously seen from the emerging market index. In fact, over the last 25 years, the Asian market had experienced 7 major drawdowns, where investors saw more than 25% in losses in a short period of time. However, just like the emerging markets, the Asian markets have also recovered in every instances. From the 1998 Asian financial crisis to the 2000 dot-com bust, 2008 global financial crisis, 2013 taper tantrum, 2018 trade war with China, and most recently 2020 COVID-19 pandemic, the Asian equity had recovered and prospered after every major drawdown, and fundamentally, the region as a whole had developed and progressed significantly since 1998, despite the ups and downs that we've experienced over the last 25 years. Long story short, yes, investing in the emerging and developing market is riskier in the short run, as investors will be experiencing higher levels of price swings more frequently than we may like to have. But in the long run, investing in the emerging market had proved to be a profitable operation 100% of the time, as long as our investment horizon is long and we are investing in the right emerging market space. Part 3. What can you do in times of large drawdown and losses? Now, in times of extreme price swings and potential paper losses, what can you do to ensure that your investment operations remains profitable in the long run? The first thing you need to do in times like this is to calm down, right? And understand that recessions and corrections are part and parcels of investing. You need to understand that businesses and investments behave in cycles. And every cycles, there are periods of an expansion where things will perform well, and there are periods of recession where things will perform not as well as we like it to be. Recognize that this type of cyclical behavior is normal, and that as long as the growth trend remains to be upwards sloping, which is often the case for emerging and developing markets, in the long run, your investments will recover and you will be able to make a profit by capturing the long-term growth of the emerging and developing markets that you invest in. The second thing that you need to do is to stay invested for the long term and don't try to time the market, right? As humans, we are susceptible to investment biases which may cause us to behave impulsively, that may make us feel good in the short run but sabotages our performances in the long run. Trying to time the market in an attempt to limit our losses or to make a profit in the short run developments is usually the result of us succumbing to our investment biases that often goes against common investment principles. And with all the studies that was previously conducted on the effectiveness of market timing, we all know that that is a fool's errand, right? To help you avoid succumbing to investment biases that may sabotage your long-term performances, I've created a video on common investment biases and how you can avoid them, which I'll link at the end of this video, so do check them out after you've finished watching this video. The third thing that you want to do is to stop listening to the media and refer back to your financial model and analysis. Now, in times of uncertainty, especially high uncertainty, stop listening to the media that thrives on making clickbait headlines to capture your attention and contents that will exacerbate your tendencies to succumb to the investment biases. What you should do is to refer back to your investment's SOP, standard operating procedures, and fall back on your financial modeling and analysis to decide what the next best move would be in times of rising and high uncertainty. By sticking to your investment SOP, financial modeling and analysis, you will avoid making a decision that is not consistent with your investment strategy, and most importantly, you will not make any decision that will impede your long-term investment performances, as now you are guided by facts and fundamentals instead of your irrational emotions. Summary. Long story short, investing in an emerging market space does carry higher risk in the form of more extreme price behaviors in the short run. But as we had seen in both the emerging market index as well as the Asian equity index, as long as your investment horizon is long and the growth trend of your investments is upward sloping, your investments will recover from the short-term losses, and in the long run, you will be able to profit from the fundamental growth of the very emerging markets that you invest in. Remember, in times of high volatility, drawdown and losses, do not panic. Calm down, turn off the media, stay invested and revisit your investments SOP, financial models, and analysis. Do not succumb to your investment biases and short-term emotional impulses. Now that's all I have for this video today. If you found my content useful, please drop me a like and subscribe to this channel. In next week's video, I'll be going through a checklist of things that you need to do to prepare yourself financially in 2022. So do subscribe to this channel to stay updated with the weekly upload. If you would like to find out more about how you can leverage on my experience and benefit from my financial planning services, you can find out more information on my website or reach out to me directly on LinkedIn. All the links will be in the description below. Stay safe and I hope to hear from you soon.